Like Jim said, we're actively raising for our Fund VI offering right now. We're targeting a $450 million raise, and we're targeting net returns to the investor of 11 to 15%. And we have a special deal with the white coat investors. Typically, we offer an 8% preferred return, a full return of capital, and a 70-30 split, 70% to the investor, 30% to MLG overall to target that 11 to 15%. For the white coat group, we've offered improved terms of 8% preferred return, full return to capital, and a 75-25 split, which would result in property level returns closer to 12 to 16% net to the investor. So we're already past that $5 million threshold required to achieve those terms, and would love to continue to add more of the white coat investor base to our Fund VI.
Yeah, awesome. That's good news to hear we've hit that threshold. So it's always nice to get a little bit better terms. Let's get into a little bit more of the details of Fund VI. You mentioned it's targeted a $400 million raise. How much money has been raised so far?
We are sitting at right around 155 to 160 million, and we're, I would say, just under a year into our raise so far.
And it's got, I think you said earlier, 19 more months before it closes. But if you hit 400 million, you'll close it early?
That's right. Yep, either or, whichever happens first.
Okay, and that, again, is going to be predominantly or entirely multifamily?
Predominantly multifamily. We actually already have some flex industrial in the fund that we're excited about, and we have a retail deal as well, a premier location retail deal. We don't buy a ton of retail, but when we do, we buy, our general strategy is to buy a problem in a great location that we can fix and then sell. And that's the case in this instance. We bought a really well located piece of retail in the Twin Cities, and we'll look to sell that here in the near term.
Okay. And how much of the portfolio ends up being value add versus core plus?
We don't promise a specific allocation between the two. I would say Fund VI is definitely skewing more core plus right now, just like I said, a bias towards higher quality real estate and higher quality locations. We're doing less of really none of the 70s, 80s stuff, very, very little of that, and focus on 90s and newer, really functional real estate. And that just gives its way more towards a core plus type return profile and risk profile.
Okay. And you mentioned the preferred 8% return and the 75-25 split. Tell us about the other fees associated with investing with MLG.
Yeah, so the big one is we have a 1.25% asset management fee that's charged on your outstanding invested equity. The 8% that we owe you is net of that. So really, to get you 8%, we have to produce a 9.25%. And that's, I think, actually pretty low relative to what we see a lot of other groups doing in the marketplace. The other big fee that's relevant is we have a 1% acquisition fee that's taken on each acquisition. That's a one-time fee as 1% of the purchase price. And those are the two big ones. There's some other ones that are at play. If we self-manage, we pay our affiliate management company a market rate management fee. If we have a third party or a partner do that, we pay them that fee. It's kind of cost of doing business in multifamily. Similar with construction management. If we do a project, there's usually a 5 to 7.5% fee on that. Again, either to us or to the partner that's executing on that work.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.